Yes, long life and abundance, brothers and sisters. Welcome to my YouTube, where I will be sharing my experience with trading, emotions, my life, business, and so on. I have been wanting to do this video for a very long time about trading, but when I first figured out about trading, I figured out that it was a sector where I needed to be very skeptical, or let me say very cautious with the stuff that I say. And I realized that in trading, there's a lot of people that trying to like scam and trying to promote false dreams that in reality they can't make it happen. So, I was skeptical and I was making videos, but over the years, after 5 years, I get a lot confident in what I'm doing. And I reached to a point where I could also teach and show somebody what exactly the I does do and what I does do to stay focused and stay consistent for the long term. So before I start, I want to say thank you to a few people. Um, many people then. And the first, I want to thank YouTube University. If it wasn't for YouTube and all of these people that I get on YouTube, I wouldn't be where I'm at today. If it's emotionally, mentally, um, when it comes to trading and understanding money, YouTube is where and Google is where I get a lot of my information and my due diligence. I also got a special thank you for Johan Brooks for giving me the open perspective into macroeconomics and a bigger picture when it comes to investing and trading. And I thank you as well, Nico Wilson, which is another guy from St. Martin. Well, he also is, in my eyes, like a technical expert, master in technicals, and he's, in my eyes, not only a mentor but one of the top traders. So I also thank him for spending a lot of time with me in my beginning journey and explaining me the ropes to the way he do his thing. So I thank him a lot as well. And the last is a group that I created a few years ago, Vision Board Group. Um, where these is guys also from St. Martin, where they in different journeys learn about trading and we all come together and we teach each other and we show each other the best ways to tackle the market, and if somebody ain't have the right mentality or ain't going through a losing streak, we kind of motivate each other to understand this is just part of the game. So before I start, I just want to thank everybody um for the little information and the pieces to the puzzle to where I'm at today. So thank you. My name is Jeremy Richardson. I'm 29 years of age. Born in St. Martin, raised with both of my parents. I have two brothers and two sisters. I live in the Netherlands since 2012. I came to the Netherlands when I was 18 years of age. Currently, I'm a trader, businessman, delivery driver, family man, and caregiver. And my goals is to introduce and build traders, businessmen, and women in the Caribbean and in Africa. So that's a big goal of mine is I want to share with you guys. So you guys can understand like why I doing these videos. And you can also see a couple of pictures there when here on the right on top. There's where I first when I was on the airport leaving to come to Holland in 2012. And you can see me there when I was younger. I was never afraid of camera. I actually used to dance. Um, so and this is me in Holland purchasing one of my cars. When I came to Holland in 2012, my mindset was just having fun, friends. I was going to school at the time, which I was doing business administration, and I was just creating liabilities for myself. I didn't even know what liabilities was or assets, you know. But at the same time, still understanding, going to own and living. Actually, was living with my siblings before I end up living on my own. And in 2017, I was over 10 grand in debt. And where it ended up a big thing to me was because I ended up going to the grocery store, and I know pinning, and I realized I couldn't use my card, and then figure out that my card was frozen. And I remember calling the bank and I was asking, like, what happened? They told me that I had fines that had to be paid and I had to have those things arranged. And I remember thinking and saying to myself, life wasn't fair. And I remember blaming everything but myself. So it kind of took me a while to realize what can I do. And I went to the School of Learning, trying to get my stuff arranged because I was trying to do it on my own, but it was very difficult. So I was advised from one of my classmates at the time, where I did that and I was over 10 grand in debt. And I wanted to change my life around. I wanted a better life. Basically, in early 2018, I was researching how to be rich and stumbled across this book that changed my life, which is Cash Flow Quadrant Guide to Financial Freedom. This was from Robert Kiyosaki. This was a book that I also spoke about a few years ago. I explained it to a couple of more people on social media about the ESBI, employee, self-owned business owner, and investor. And I ended up learning the reasons why it was important to understand these things. And the point of it was basically the taxes. Basically, the business owner and the investor pays the least taxes, and on the E and the S you pay the most taxes. So it was actually understanding, and when I start to understand those things, caused me to start reading more books, and then I read Rich Dad Poor Dad, and I get familiar with corporations, investing in tangible assets, and so on. So I end up having three things that I feel like should be my goals, and at the time, and it was making a plan for myself, studying money and how the system worked. So from 2018, that was my goals. Make a planning, the stuff that you want to do, and study money and how the system work. So there's where I end up making several business plans. There's where you kind of see your media professionals today. You kind of see also like stuff like your media, Captain Car Rentals. But everything first start off right here, and that was trading. So when I basically figure out about investing, I end up figuring out about trading. I never heard about trading before. So when I hear about trading, I was so intrigued, I went in head first. So I want to explain you guys a little bit about trading and why for me is important. So I want to give you a little story before go into trading, and it's basically growing up. I basically always wanted to drive car, but my parents never allowed me to drive their car because I didn't have my license at the time, and it was understandable. So I made a plan to convince my father to get me to driving school when I 17 years of age, a couple months before I made 18. So when I made 18 years of age, I could get my license one time. And it ended up working. My father ended up giving me the opportunity where I could have started my driving class, which I did. I did it when I was 17, almost 18. And when I made 18 years of age, a couple of days after I did the exams, I passed, and everything worked out just as planned. And if you really understand my story, you kind of understand. I figured out about trading in the age of 24. I was already an adult, and I just see for the next generation after that, if they probably understand about trading or understand about business at a younger age, 17, 16, they could start understanding and start studying now. So when they're 18 and they could get a broker, or when they're 18 and they could have a business, they have a good idea to how these things operate or how these things work. So that is why for me it was time to be like, yo, Jeremy, you do understand something. You actually are making money, so you have now the proof to now show the people like, okay, cool, this is what I just do. And one thing about trading, what I personally don't believe, there's not one way to trading. But what I do believe that you need to try your best to research as much as you can and get also the bigger picture to things. So you could look at it in a micro or a macro, but like I say, it's always important to just look at it in two views. Basically, trading is basically the act of buying and selling financial instruments like shares, forex, and indices without directly owning them, in the hopes of making a profit from changes in the price movements. Just in case, this information is from Google, and a lot of this information is also to show you that sometimes you just take a little research. You understand? Sometimes you're asking yourself these questions, but why you're not personally researching? So that's why also this information is here to also sharpen you guys. And like I just hear from a lot of my other brothers, it is be very good when I just explain certain things. So the act of buying and selling, it's good to read and understand that piece because a lot of people still feel, especially the older generation, they don't understand that you could sell and make money. So there it shows that you could buy and make money, you could sell and make money. And you could basically buy financial instruments. And then they give you a couple of examples. Like shares, they mean like stocks, forex, like currencies, and then indices like the S&P 500 and so on. And when they say without directly owning them, that means like I could buy crude oil and I don't need 110 barrels of oil in my house. I just could buy the contract of the oil and I own it to the extent that the difference of the fluctuation, I could make or lose money on that fluctuation. So basically, when I figured out that that was possible, I was like, wow, this is something, it's like a dream come true. This is something I would love to do because I could spend time on a computer, but I could also spend time with my family. So that was something like a plus. So this is also a picture I also get from Google that was also a nice format to understanding to, how the how we start from the trade and where this trade end up. So they have financial institution that issues an asset. So basically, like we were just talking about oil, let me stay on that. So financial institution that issues oil, right? So it can go from there, and then you can see at the bottom it says sell big batches of asset. So basically, the financial institution that issues oil sells big batches of assets to the big banks, big financial institutions. Once is sent there, again is being sold again. Big batches of assets is now being sold to the online brokers and the small financial institution. Same goes to they also buying and selling the assets in between the small financial institutions and the big financial institutions and the big banks. And here as well, in the last piece, you see us by the end client, you see retail brokers, retail traders, and companies. There's where we come in. And then you can see at the bottom, it says trade with small amounts of the asset, which is the oil. So there's where we just more or less be trading, and there where you kind of see that we have the connection to the online broker. And that's actually what it is. In order for us to trade, we need an online broker. And once we have the online broker, we basically could buy and sell financial instruments. So basically today I'm gonna be showing you guys my setup, my personal setup. Everybody got their setup. I know a lot of people, when $100 fall on the floor, they basically stand up on it, they look around and make sure nobody ain't seen, and I understand that's how most Black people just do. Or not just in general, most of us just do that. But for me, like I want to like show my people because like I say, there's no need to do those things because if you look at history, we don't have much. and it's about time we start to have something. And I don't want to be in by myself. I want to be in collectively. So it's always good, to share the information, because it's not always information, it's the action. So I sharing the information, but if you guys don't put in the work to study or understand, you will never make it for yourself. So basically, I call my setup the Pac-Man. Several reasons why I like to call it a Pac-Man, but it's three main parts of this A plus setup. I call it a A plus setup. I break it down in three pieces: psychology, risk management, and technical analysis. And a short piece I like to say about a Pac-Man, for those that know the game, is a game where you could see that yellow, this, that's basically Pac-Man. And Pac-Man gotta eat these dots. And once he eat all the dots, he can go to the next level. But they have goals. They have 4 goals, if I'm mistaken, 4 or 5 goals, if I'm mistaken. And they also plays a role. They have a scatter phase and a chase phase. And they have a formula to the way they does move. Each goals have a formation and a formula to the way they move. And I see the same way to trade. I see the dots like liquidity. We always trying to make liquidity. We always trying to eat pips. We always trying to make follow the big banks and the big institutions. And we always gotta watch out from liquidity, and just understanding that the game is a probability game in the end of the day. But Pac-Man, that was always something that when it comes to my setup, I always see like I always Pac-Man in. But yeah, I just wanted to say that. So psychology, probability. In this video per se, I will be going into the technical with supply and demand, volume, and liquidity. I will separate these videos, risk management and psychology, um, in other videos. But in this video, I will go a quick run through with what those other videos will be about. So basically, I would have a video about psychology, talking about a probability mindset and how I personally just keep my mind in a probability mindset. So one of them I will share with you guys. One in the goal is basically I make sure I never expecting out of my trade. So once I know I'm not expecting out of my trade, I know I'm in a probability mindset. And vice versa. I know that I expecting from the trade. So if like I had a buy position and I expecting the market to go up, or I would want the market to go up, I would make sure that if I'm saying things like, yeah, I want this market to keep going up, keep going up. Like I hoping, like I know I'm not in a probability mindset, because when I'm in a probability mindset, that's when I just close my laptop. Like I don't really care. Like I don't do the hard part already. And that was the analyzation and being patient to wait for the market to execute. So that's a tip. Another one, bulls make money, bears make money, pigs get slaughtered. That's also for me another psychology that I also keep to myself, where it's just like bulls basically mean buyers, so buyers make money, bears mean sellers, sellers make money, but pigs get slaughtered. So basically the pigs is the greedy people. One thing about trading, if you greedy, you tend to get slaughtered. You tend not to be profitable in the long run. And it's just simply like if you understand terms, like when they say like trading is 90% um um psychological and 10% technicals, you will kind of understand to why if you are emotional, which is greed, you will get slaughtered. So it's just a type of mindset that you have to have, where you just take what you get and you keep it moving. And yes. And the last one, which is emotion. I have emotion. You can see the E is spacious. It's not by mistake, and it's simply because like I personally, in the beginning, like didn't really like took it serious that emotion has emotion, you know, and every like just like I see it, just like it once you don't make a rational decision, you automatically making an emotional decision. And it's like you need to sometimes stop making like you need to stop making emotional decisions and make rational decisions. And that is something where I just had so much problems with because I literally didn't, I wouldn't say I didn't know, but I just never took it. I wasn't really accountable to the emotional actions that I used to make, and it just used to make me always self-sabotage myself. And that was just something that I had to work within myself, and it took a very long time. But like I noticed, you need to keep grinding and believing in yourself that you will be able to change and make yourself the best trader you will want to be. And it's not only a trader in anything you want to do, like you gotta go all in. So the next one is risk management, risk reward. How much I risking in a trade and how much I'm making in a trade. Like every time I think about risk reward, how much I risking, reward, how much I'm making. Like that is very important to me on every trade. Like if I don't know how much I'm risking, like or I don't know how much I'm going to make on that trade, like I'm going in emotionally. So that's when it comes to risk management, I always focus in on risk reward. Profit factor. Profit factor is basically so if I risk in $2 a trade, right? So if I'm wrong, I can lose $2. But if I right, I can be right $4. My profit factor going to be a 2. Why? Because I make 2 times how much I was risking. So your profit factor going to be 2. So the reason why I focus on profit factor is just for me to make sure I'm getting 2 times my money or 3 times my money. It makes me make sure that I'm getting more than when I'm wrong. Profit factor. And last one is the hit rate. In actuality, like I'm not saying like your win percentage or your hit rate is important, but I see that is important in the sense of your calculation. Like in every calculation, if it's from your profit factor or your risk reward, like you always need to know like your win rate, your hit rate. So when you're doing the calculations, you kind of can have an idea like what why you making money. And I can give you a quick example. Is a dude, a guy that I that in 1987 to 1988, Richard Dennis made over $400 million with a 5% win rate. So if we have to take that in a example of 100 trades, means he lose 95 trades and win 5 trades. So if you understand profit factor, and I explain you the way I said, I know you have like the win rate, which in that sense is a 5%. You could then see that in order for him to still make money with a 5% win rate, his profit factor would need to be a 20. So he would need to make 20 times his money when he write in order for the whole calculation to make sense. And that's something where I'm going to be teaching you guys on my YouTube channel. And yeah, it just gives you a more, you understand. And trust me, I'm not good in numbers. I always got a calculator. I always use my calculator. But the the ideas of formations, you can get it. Don't worry, believe. Technical analysis. Let's go into it. Supply and demand. I'm going to show that everything that I just do is supply and demand. I look for volume. I'm going to explain why volume is important. I can also show you guys liquidity and why is liquidity important. The only thing I'm not going to show in this video is mastering candlesticks, but I do have a video on YouTube that I'm willing to share with you guys that you guys can go and look at that video. Like that video is like the best explanation of candlesticks, and they will do like a way better explanation than me. So I would just to look at that video, and then you could come back and we could start talking more about candlesticks with the formations that I may explain you today. Let's go. So supply and demand. Supply refers to the amount of an asset that is available, while demand is the quantity of an asset that people are willing to buy. As supply of an asset increases, its value declines. Conversely, as supply of an asset decreases, its value rises. So I want to give an example like with milk, right? For now, like we got milk, right? We got milk selling. Like when you think about supply, you need to think as the entrepreneur. So let me say I is the entrepreneur and I selling milk, right? And now what they're saying is supply refers to the amount of an asset that is available. So that means we have milk in the store right now is available. So you could come, you could get a milk. While demand is the quantity of an asset that people are willing to buy. So the demand is now the people, the customers, that's how much they buying at a time. So they're buying one at a time, two at a time, or three at a time. That determines on how high the demand is. Okay. And the supply is determined on how much you have available at that moment. So what it's saying here now, as supply of an asset increases, its value declines. So now think of it of we have milk in the store and we just get milk from the people who just bring the milk, the producers, them, the warehouses, they just bring this milk every week. But the demand for the milk at this point in time ain't high. But we getting every week milk, milk, milk. The supply of milk is increasing. Could we getting a bunch of milk, but the demand is not going as fast, you know? So what gonna happen to the milk that's staying there long? It gonna end up spoiling. So in a situation like that, what you gonna do? You're gonna end up throwing away the milk. Or in a case where you realize, okay, we getting a lot of milk, but they ain't buying as much milk, you gonna end up now dropping the price. So people could be like, yo, the milk costs $1.50. No, let me go buy milk now over there. So you're going to need to drop the price of the milk so people could take and buy milk so you could get rid of this milk. And that is exactly what it's saying is the law of supply and demand. The supply of an asset increases. So if they keep bringing milk every week, producing milk every week, but they ain't buying it, it gonna eventually the value going to decrease because like I use an example. And conversely, as supply of an asset decrease, its value increases. So I like an example that I would like with laptops. If same goes, we selling laptops and we only have 3 laptops, but when we can get the next bunch of laptops is 4 months from now. So we don't have much available in the store. We only got 3. What do you think gonna happen with the value? And it's saying here the value going to rise because the supply is decreased. Why? Because now you got people that want a laptop, and now you're gonna have more people that want a laptop right now, and you only have 3 laptops. So that's going to cause the laptop to go up in price because people don't want to wait so long, 4 months for this laptop. So now people will be willing to pay as much money for this laptop to get this laptop now, and whoever miss out and don't got the money to pay, they snooze, they lose. And there's the same understanding of our supply and demand. So basically, you can see photos where I use examples of my setup. These is 3 tools that I personally just use, rinse and repeat. And I don't use nothing else but these 3. So basically, you can see from on the top left, you can see supply and demand zones. Zones, you could call them support and resistance. So the demand, which is the blue, this area would be called demand area, which would be the buyers, which would be the support area, and here would be the where the sellers at. Here there would be the resistance. But in this case, it would be zones. So it would be an area. It wouldn't be a line. It would be an area. So these areas, I call them supply and demand zones. Why? Because I try to make this simple for myself. And in the end of the day, everything is supply and demand. I'm going to go more in detail in more like a course or something like that, but that's more in the future. But like I said, I just trying my best to explain everything in one video, so you guys can have more idea. The next thing I just use is trend lines. Same thing with trend lines. I also see it as supply and demand. So if I see in a down trend line, if the market in a downtrend and I put a trend line coming down, that line coming down would become my supply area where I will be looking for sales. You understand? And same goes for a demand area. If I see a trend going up and I see a trend line, I would plot that trend line as the demand area. And the last tool I just use to find supply and demand levels is the Fibonacci. So it's not another thing that is also explained, would be explained in the future, would be when the market in no man's land. So that's a point of time where when the market don't have a demand or supply level to the left. So I would call that no man's land. And then I would end up pulling my Fibonacci. And then once I start to see it retrace, I use my Fibonacci again as supply and demand levels. So if it's an uptrend, so in this scenario at the bottom, you can see this is the Fibonacci retracement tool. And to the right, you could see basically a bunch of numbers. All the way on top is a green, you can see 61.8. But that's actually TP2. The second green line, 0.27. That's TP1. And then the 0, and then you see 0.236, 0.382, 0.5, 0.618, 0.686, 0.886, and then 100. And then you have negative 1.1, negative 1.2. So these retracements levels mean something, and I look for levels like the 61.8, the 50, and the 38.2 for retracements levels, and continuations, where I look for my supply and demand. So in this case, those levels would have been my demand levels where I will be looking for entries to buy. So I just simply show that with supply and demand zones, supply and demand trend lines, or basically Fibonacci retracement levels, to me is supply and demand. And that's basically all the tools I just use technical. The next thing that I just use in my setup that is very important is volume. Volume is a measure of quantity. In trading, the volume is the amount of a particular asset traded over a period. Volume is a key indicator of market activity and liquidity, which means that it is often presented alongside price information. Whenever a contract is traded, there must be a buyer and a seller for the transaction to take place. And that was something for me. It took me a while to understand that you need a buyer on the other side if you want to sell, and you need a seller on the other side if you want to buy. You would only notice that depending on the broker that you're using, or you would notice that with how liquid a market is, because depending on how volatile a pair is, you would know if you will be able to get in and get out in the market. Volume, in our case, the way I just use it, I just use to see if volume increasing, if the volume decreasing, or if the volume neutral. Why? Because by me looking if the volume increasing, it is telling me that the market is going to continue in a certain direction, or it's going to break in a certain direction. It's going to break a certain structure level. If I see a market decreasing, I based off my setup, it means it's going to respect a certain level, or the market is basically pulling back. Or if the market neutral, it often means based off of my setup that the market is not ready, or the market will be very choppy. So is ways of how I just identify that. So basically, number one, I just use TradingView to look at my pairs, and I don't look at the normal volume bars. I don't use, I delete those volume bars, and I look for the volume bar that has WAESHK. So you can see in the picture all the way to the top, to the where you can see the volume, you can see on top of the picture, you can see WAESHK. So those is the volume bars that I use, and those is the volume bars that I just identify if it's increasing, decreasing, neutral. So basically also in those, in that bar, those bars has a formula, and I like that formula. And you could see like they has a horizontal where you're seeing dots going horizontal. So those dots that going horizontal is very important to me, because those is the dots that I just use to identify if it increases, decreasing, or it neutral. So, and yeah, like I said, that indicator come with those dots, and those dots is important for what I look for. So if it increasing, it gotta have multiple volume bars above the horizontal dots. If it decreasing, it should start with the bars closing above the horizontal dots, with a follow-up with lower closed bars until volume bar close below the horizontal dots. So that with the decrease, it takes a while. It takes several candles of closing until it starts to close below. And the neutral, how that is be identified is literally it need to have multiple bars close below the horizontal dot. So once I got like 4-5 daily bars below the dotted horizontal dots, I don't know one time that the volume is neutral. It can be very choppy, and whatever analysis I'm more or less seeing, it might not be ready at this point in time. So it might take a couple of days, or probably take a week. So that is how I personally just use the volume, and the way I take advantage, and how it helps me take advantage of the chart. Let's go. And the last one is liquidity. So liquidity describes the extent to which an asset can be bought and sold quickly and at stable prices and converted to cash. So liquidity is a lot of those fast little movements that you're seeing. And liquidity does also like increase like when people know that that market is stable, and also like if it's a market that you can close your position and you can withdraw. And like I said, that's again where you would see brokers and charts that have a lot of volatility. Those is usually the charts that you can get in, come out. You always have an opposite trade on the opposite side. So liquidity, that's basically a little graph based off of Google, was liquidity. So how I just use liquidity is how did it explain stop loss orders. So represent liquidity in the market. And the big players such as banks, big institutions, hedge funds, etc. need liquidity. Those big players can't just trade, just, sorry, Those big players cannot just enter a trade at once, but they slowly have to build a position by hunting for liquidity. So that's the way I just tackle liquidity in the market. I look for liquidity in the sense of where is the demand zones, where are the supply zones, where are the trend line zones, everything I just explained you, where are those levels? Once I know where those levels is, I know, okay, at a supply level, so like here, so at a supplies level, I know on top of the supplies level have liquidity. Same goes at the demand level. At the demand level, below the demand level have liquidity. So I expect for the liquidity to be taken out. So I use liquidity for my take profits and my stop losses. So a little tip that I can give, a little technique that, sorry guys, that I just use to use my stop losses is basically if I see a supply zone or supply trend line, anything, oh my, a Fibonacci supply zone, right? What I would do, I would draw my zone and I would wait until that area get liquidated. After that area get liquidated and I see now we pushing back in the direction now that I wanted to push back in, now I'm going to use that liquidation level as my stop loss. So now I seen like, okay, now I have the best entry and I have the best stop loss area. You understand? Because I waited for the liquidity to happen. Now the liquidity happened. Now, in actuality, it should not liquidate after that again. If it do that, you're wrong. You know, you just take your loss, you just leave it, walk away. You know, we go back to the path to the psychology, you know, the paths where the greed and all of those things, and you learn how to just walk away, you know, it doing something else. But in actuality, 60% of the time, you will have no problem. You can put it above the liquidity and everything just gonna play out beautiful. You know, but like I say, it's a probability game. This is not 100% game. You know, and that's the thing I think why a lot of people is can't make money because they want to win all the time. You want to win all the time. Like you got to want to lose that. Like you got to accept losing. And I just know how difficult it was for me. So I know it can be difficult for you guys because you guys want to win all the time. So basically that was the end of my PowerPoint. I really hope you guys learned something from it. Subscribe because I'm going to drop more videos. Like I said, I still got 2 videos ready to go for you guys talking about risk management and the psychology. So don't miss it. I'm going to be giving away everything that I have using. So you guys stick true, follow true, and pull out your books. Keep taking action. You know what it is. This is about Jeremy on Life in Abundance. We out. Peace.